Good morning, everyone. How's it going? Hope you had a great weekend. We're half an hour from starting or opening on Monday, August 12th. Last week, we had quite a bit of action. We had volatility spike. We dropped on Monday and then spent the rest of the week recovering. So the question we want to answer now is, have we recovered enough? Are we going to continue to recover? Are we going to go bull market again? Or are we going to come back down and chop sideways or go into a bear market? So let's take a look at how we're opening it up today and how that colors our viewpoint. So we'll take a look at our futures, and they're very muted, actually. S&P 500 were up about 25 basis points. NASDAQ, we're about 25 basis points. And the Dow, about 10, 12, 15 basis points. So that's really mild compared to last week. Last week, we were seeing anywhere from 75 to 150 basis points. So this is super, super quiet. This is more like what we normally see and what we would normally call random movement. Normally, we would say about 30, 35 basis points would start to begin our line of whether something was random or not. And last week, 75 or 100, even a 1 percentage point was considered random. So this is really, really quiet. And if that means that the two things could be happening. Either we are getting quiet because confidence is coming back into the market, or we're getting quiet because we've got Fed data coming up and the market needs to see what that data comes out as before it makes a decision on which direction to go. So one way we can try to discern which one of those two it is we can take a look at our VIX. Our VIX is here at 20.49, and more importantly than the actual level is the movement. What did this do based on the futures going up quarter of a basis point? And basically it did nothing. It's still very elevated. It didn't really move. We have a small bar right here. And normally we would expect a small bar, but what's important is that we are still above where we were on Friday. So we started out up here and then we actually traded down, or the VIX came down a little bit, which is what you would expect if the futures are moving up. But why is it above the level of Friday? If futures are above the level of Friday, we should be a little bit below that. So that's telling me that it's more likely that this lowered, or at least in the futures market, the lowered volatility is more due to waiting for data rather than confidence in this market. Let's take a quick look at our markets, and then we will take a look at the data that is coming up. I said over the weekend on the weekly market review that in particular, am not super interested in the data that's coming out because it's probably not going to change our situation no matter what. But we can dig into it. We can get an idea of what institutions might be thinking. So we came down, we floated up. Is this high enough? Well, I've got these three, the MA50, and spanning right up of and below the MA50s, they're so close to it that I might as well just get rid of them, are levels that are likely points of reversal, or they're important points. We can come up and then go through or touch them and then come back down. So that's just to say it's an important level, because if I can't draw the same thing right where we are right now. I can't say, oh, we're going to go up or we're going to go down or sideways. You can always say that, okay, and right, you would go up or down or sideways. No, this is not you can't just pick a level and just say, hey, right here, we could go up or down or sideways. No, there has to be a reason. There has to be a reason for us to believe that at this particular point that it is an inflection point, a decision point. Otherwise, they just move. When we reached here, we didn't say, oh, it might turn right back down. We said it might hit the EMA 8 and then turn back down. So we are at a point here where we came a little above the EMA 8. So we're at a point where we could still consider that the EMA 8, but given that futures are a little bit up, we'll just say we made it through that EMA 8. So we could turn around that at that EMA 20 or that MA 50, which and or maybe slightly below or slightly above that. The MA 50 is a stronger point than the EMA 20, so it'll offer a lot more resistance than the EMA 20, and that's why it is a more important inflection point. So why is this important to us? Because we want to know if we should get excited if we could see a movement upwards today. And if we just move to the EMA 20, then no, because it could easily just change direction from there. If we move up to the MA 50, again, no, because that is another inflection point. If we move above that MA 50, now we're talking. And then if we move above that 555 level, then we're probably headed towards the previous all-time high over here. Is that going to happen? That is going to be dependent on catalysts. And the catalyst this week is the Fed data, the CPI, the PPI. Even though I'm not particularly interested in it because I'm fairly confident of what it's going to tell us and what it means for everyone for the for a rate cut in September. The other people on Wall Street or other institutions, they may not agree with me, and so they're the ones with a huge amount of capital, and they are the ones that might push this market around until we actually get the rate decision on September 18th. So let's take a look at what they might be looking at. And how things could be interpreted versus how the Fed will be interpreting it. So nothing today, nothing. PPI. PPI over here. So right now we're looking at a consensus of 2.6 and a consensus range of 2.3 to 2.6. What's interesting right here is those two are the exact same number, meaning that a year ago, we had the exact same PPI. So what that means is we made zero progress on inflation. Now, other people will say, or some people in the Fed might say, well, Kane, it got a lot higher before it came back down to 2.6. So it went way up and then went down. And what we're looking at is the trajectory, because it started from a higher point and now it's come down to 2.6. Whereas over here, this was 2.6 and we were on our way up. Well, if your policies were effective, why did it continue to go up? And why did it continue to go up so high? The PPI number, I'm not too sure about, but the CPI hit like 7 or 8%. So why? If your policies are effective and actually made a difference, why did we overshoot this 2.6 number so far and then come all the way back down so that in the last year, we basically were at the exact same point? So if we were talking about physics, we would say no work is done, because work is force over distance, or force over distance. And if our distance is zero, then it doesn't matter how big your force was, your amount of work done is zero. You ended up in the exact same place. So if we take that perspective and just say, well, we've made zero progress on PPI, let's see if the same thing's true on CPI. Yeah, exact same. 3.0, 3.0. We made zero progress. And if inflation was high back then, if inflation was a concern back then, so much so that you had to implement policies in order to combat inflation, why is it not high right now? Why are we not still worried about it? Why is it that we think that we're done and that we can start lowering rates? It just seems weird. It's like, Kane, it's a trajectory. It's going to keep on going, and we need to pull off. No, why do you need to stimulate your economy right now? You don't. If the data is telling me that's the exact same, that means that we've made zero progress. If you told me that this was like 2.5. Okay, fine. I can buy that. But we're at the exact same level. So uh, people on Wall Street are buying into it for whatever reason because we've got 100% priced in that we're getting the rate cuts in September. So I'm going to stick by my statements well, it's been for a while now, but especially last week and in the weekly market review, I made a very strong conviction statement saying that I don't care what the news is saying, I don't care what the market is saying, the chances of a rate cut in September are still very, very low. So this is a disparity, and this is something that will have to resolve itself. Either I'm wrong or the market is wrong. And we can position ourselves to take advantage of this because the viewpoint, when your viewpoint is drastically different than what the market says, that's where you get really, really nice tail risk trades. So as long as you manage your risk properly and you go in on small size and you design it so that if you're right, you make way, 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 way more than when you're wrong, then the trades will work. Because even if I'm wrong, then I just lost a little bit of money. But if I was right, then I made many multiples of whatever I would have lost. So this type of situation is actually good. I can't make sense of what these guys are thinking. I'm going to go by what I'm thinking, but I could be wrong. So I only put a little bit at risk. But if I end up being right, I make a whole bunch of money. So this is starting to create a very lucrative tail risk type of situation. We just have to start to think about how to take advantage of it. Am I going to do it in TLT? Does it have an implication on the major indices or a very specific sector? So that's something that I'm going to be thinking about all week. There's no rush to put this on. We have all the way until September 18th, and the market's not going to wake up to it anytime soon unless the data comes in drastically different, which I don't think it will. So even though this market seems to be waiting and pausing for that data, I don't think it's going to make a big difference, which is why I was saying over the weekend that I'm not really going to be watching it. What I'm watching right now are the technical levels, and more specifically, are we going to break the MA200 or the MA50? And if it's neither, then we're just going to have this large volatility, large range chop for a while. But I'm going to be watching very carefully of what catalysts there may be in order to push us through either one of those two levels. It doesn't seem like to me that it's going to be the CPI, PPI data. I don't think we're going to get massive surprises on that data. So it's got to be something else. And right now, I can't see. I don't know what that something else might be. It's not going to be earnings. We're pretty much done. I think Zacks is the one that puts out a lot of, or FactSet, and Zacks put out a lot of data on earnings. And if I remember correctly, FactSet was reporting that over 98% of the S&P 500 stocks have already reported. So if that's true, then there's really not that much left for us to look at in terms of earnings and their effect on the overall markets. So this week we do have Cisco, HD, Walmart, Baba's, more China, and Applied Materials. So those will be interesting. It's interesting that we have a couple of financials here also, but those are non-US based. So maybe that's why. So in any case, earnings are going to they're basically done. So we don't have much effect from them. And our CPI, PPI report, or what the Fed is going to do, that's not going to have a huge effect since we've pretty much already concluded that we're cutting by 25 to 50 basis points. Now, we did talk about over the weekend how the particular shift in between these two numbers could still have an impact on the market, but this market has concluded that we're going to get a rate cut. And until we have strong data suggesting otherwise, then, or we actually get the event and it's different than the expectation, then it's not going to have an effect on the market. So right now, me personally, I don't see any other forces. So I'm just going to go purely by technicals. And my technicals say EMA 20 or MA 50 this week. If we continue this upward trajectory, where we are right now is not a bad place for us to reverse, but given that we already kind of made it above the EMA 8 and we're opening higher, and our VIX is still hasn't really reacted to it, we could at the very least hit that EMA 20 before we pull back down. I've got a magnet drawn right here, meaning that I think we could pull back at least to this 520 level, if not further to this 512, 513 level indicated by this VWAP, or that MA200 by the end of this week. But that will be dependent on the strength of the data that comes out. If we get expectation, then we might just flop between a more narrow range. So call it that EMA 20 and MA 150 or the VWAP. And then if we're off of expectations, then we could hit that MA 50 and MA 200. Again, I don't think we'll break through either of those this week. I don't think there's a strong enough catalyst in this market right now. At least the known stuff. There could be something way out of left field. An asteroid comes and takes out a continent or something like that. Then that would be something that we can't predict, or that is not a normal force inside of the markets. So barring some outside force and unknown force, then that should be the range that we trade in for this week. What does that mean for your portfolio? It means stay neutral, because we're not strongly bullish or strongly bearish. Yes, we might be directional inside a range, and if you're really short term and really nimble, you hold trades for 1 night, 2 nights, then you could capture some movement. But for the most part, we'll want to maintain neutrality throughout this. So you would want to be very careful with your sectors still. So the institutions, they panic sold into this on Monday. The Japanese carry trade started to get unwound on Thursday and then continued. And then we had a panic sell over the weekend, but then we had the institutions come in and buy a large amount of defensive sectors. And this is floating up, and some of that tech has come up as well. But if you watch the weekly market review, that is just simply saying we might be setting ourselves up for another sell downwards, because that carry trade would not have been completely unwound in just 3 days of trading. So sideways chop is very likely, and we're just going to want to be very nimble. Either we're going to hold and just accept that we're going to trade it in a range and we're probably not going to make very much money during this period, or we go shorter term and we get very nimble and we try to capture these swings up and swings down in this choppy period. So you'll probably see me starting to look for shorter term trades, 1 or 2 days, 3 or 4 days max, and try to capture some of this volatility. Volatility is a trader's best friend. Volatility plus directionality is actually the trader's best friend. But if we can get volatility and we can go short enough term, then that looks like volatility with directionality. So as long as we can go short enough, we can always capture movement when we have volatility. So we will be shortening our time frame and trying to capture some of that. So that's how we're looking. And I don't see, we went through TLT, VIX. Let's take a quick look at momentum and then we'll end. So we'll look at the major indices. We got NASDAQ 4152. That's kind of in danger zone. That's not that far above 50. We've got, and if we just turn back down, if we just turn back down, then we could easily drop below that 50% level on the MA200. Dow Jones, healthy. NASDAQ or sorry, Russell 2000, 4350, looking very similar to NASDAQ. So that's in a little bit of danger. S&P 500 is looking pretty healthy, actually. So, but sector-wise, we can see that discretionary is still struggling. Energy's right on the cusp. Tech is a little bit healthier than it was last week. So this move upwards really helped with the tech. But if we turn back down again, then we start to go into danger zone. But the number of stocks above the MA200 is actually not that bad. It's a 57%. 57%. It's not bad at all. So we want to watch out for discretionary and energy to the downside, but also the whole NASDAQ and small cap stocks. So those are the ones that are likely to lead the way down. So once we get to a bouncing point or an inflection point, then we would be looking to those stocks on our way down. So we'll start focusing on those stocks because here we have a little bit further up to float upwards potentially. So we're not looking for anything yet. We'll start looking at stuff when we start hitting areas of possible inflection. And for now, we're going to prepare ourselves to look at those small cap stocks and especially the consumer discretionary stocks. But that's it for this morning. I hope you guys have a wonderful rest of your day, and I will see you in the afternoon.